One man who's become synonymous with Bitcoin maximalism, Michael Saylor. The question everyone's been asking with Bitcoin dipping below his average buy price, is Michael facing a massive margin call? So let's break it down step by step. This is going to be intense with facts and figures. Michael Saylor isn't just a Bitcoin bull, he's the architect of one of the most aggressive corporate Bitcoin strategies in history. Back in August 2020, when Bitcoin was trading around $11,000, Strategy, then MicroStrategy, started buying BTC as their primary treasury asset. And Saylor's mantra? Bitcoin is the apex property of the human race. Fast forward to this year, 2026. Strategy has turned into world's largest corporate Bitcoin holder, with their total Bitcoin holding of over 717,000 Bitcoin at a total acquisition cost of $54 billion and an average purchase price of $76,000 per Bitcoin. That's right, over 717,000 Bitcoins. That's more than 3% of all of the Bitcoin that will ever exist. But here is the issue. Bitcoin is currently trading around $68,000. That puts their treasury value at roughly $48 billion at an unrealized loss of about $5.8 billion on paper. But our man, Saylor, keeps buying the dip. Just last week, he scooped another 2,486 BTC for $168 million at an average buy price of $67,700 per BTC. This is dollar cost averaging on steroids, funded by selling stocks and preferred shares. But is this strategy pushing Michael towards a breaking point? Welcome NAV, net asset value. It's the total value of the company assets. In this case, their Bitcoin treasury minus liabilities divided by the number of shares outstanding. For Strategy, people track MNAV, or market net asset value, how much the stock price trades compared to the Bitcoin NAV per share. If MNAV is greater than 1, the stock trades at a premium to Bitcoin value. If MNAV is less than 1, then stock trades at a discount, meaning you're buying Bitcoin on sale through the stock. Currently, Strategy's Bitcoin reserve value is $48.7 billion, and the market cap of MSTR stock is around $43 to $44 billion. So MNAV has been hovering around 0.88 to 1.18. But earlier this month, it dipped to a 17.5% discount to NAV, meaning you could buy exposure to the Bitcoin stack cheaper through the MSTR stock than buying BTC directly. But here is the big question. Does Strategy debt trigger a margin call if Bitcoin drops further? Strategy has financed a lot of its Bitcoin buys through convertible debt and equity raises. Net debt estimates around $8 billion, with convertible notes being the key. These convertible notes are senior notes or senior tranches with extremely low coupon rates, ranging from 0 basis points to 225 basis points, with maturity stretched out to 2032. So, unlike a classic margin loan where a broker forces sales if collateral drops below the threshold, these notes don't have automatic margin call trigger tied to Bitcoin price. So no forced liquidation risk here from Michael. Also, Michael has publicly stated that they can withstand extreme downside, even Bitcoin dropping to $8,000, as their Bitcoin holdings would still roughly match net debt and their cash reserves to cover $2.25 billion in interest payments. Plus, Their debt is spread out over years, not due tomorrow, and their plan is to equitize debt if needed, meaning convert it to equity instead of paying cash. Truth be told, leverage cuts both ways. With average buy cost at $76,000 and Bitcoin currently trading at $67,000, unrealized losses are massive. Stock volatility is insane. Yet, strategy keeps issuing shares or preferred stock to buy more BTC. It's a high-stakes game of amplification. Let's zoom out and see the full story. Michael Saylor bet the farm on Bitcoin in 2020. Strategy went from a software company to a Bitcoin treasury powerhouse. They have raised billions in capital to stack more sats. In bull market, MSTR has delivered insane results, but in 2026, with BTC below their average buy price, the treasury is underwater. Unrealized losses hit billions, yet Saylor keeps buying weekly purchases. If BTC tanks hard, debt servicing gets tougher, dilution accelerates, NAV compresses, but no immediate liquidation bomb. So Michael Saylor is unlikely to be margin call, but risks are certainly real.